to keep inflation out of? What should we be talking about? Should we be talking about all goods, including services? Should we be talking about commodities? Should we be talking about hourly wage rate? What should we be talking about as the sort of conceptual price that it would be nice to keep constant? I don't think that's a question that economists have talked about for hundreds of years, and I don't believe there's any answer to it.
Well, I think we've kind of narrowed it to what appears to be the case is that if everything is rising pretty rapidly, say more than 10% a year, that it generates a lot of confusion and a lot of mistakes by consumers. For example, the mortgage market begins to break down if you have inflation rates above 10%. Inflation in the 0 to 10% range, it's not so obvious choosing between, say, 0 for the cost of living index and 4%, which is the kind of choice that Americans are making now. There doesn't seem to be a lot at stake there. It's hard to show that it's hard to find some principles where you can decide between 0 and 4. They're both very small numbers for this purpose, and it seems to me once you get a monetary policy which is delivering price stability in the sense that prices aren't rising more than 4% per year, that you might as well relax.
When you say more than 4%,
other economic problems.
You say more than 4% a year, but stop for a moment. When Richard Nixon, as part of this package which ended the link to gold, imposed price and wage controls in 1971 because prices were rising too rapidly. They were rising at 4.5%.
Well, I would be the last person to endorse what he did.
Well, but you were concerned. I was concerned at that time with the rate of inflation. There was a lot of widespread concern about the rate of inflation. You know, the interesting thing about human beings is there's nothing they can't get adjusted to. Here in countries like Chile, they're adjusted to 20% a year. And they think it's nothing.
Or 20% a month.
Well, but Chile has some very good ways of dealing with that get around some of the problems I was talking about.
Yes, they do.
The mortgage market works fine in Chile because they have other ways of handling them.
What's interesting also is the Latin Americans have gotten used to not just 20% a year or 20% a month, but changes between 20% a year and 20% a month.
Yeah, but
somehow they know how to calibrate when things are even changing.
But it's been debilitating.
Of course, it's a stupid way to spend your energy. It's a
total
waste of time.
It imposes very high costs.
Argentina, which has been the leading victim of that, Argentinian development, for a lot of different reasons, but partly because of monetary instability, came to a halt when that process began.
Which gets back in some ways to what you originally started the discussion with, is why does someone hold this piece of paper? In the case of Argentina, the peso would be devalued or going down in value 10% a month, then 20, then 100% a month, then back to 10. Eventually, people stop using pesos and they start using greenbacks, they start using dollars. So somehow there's this psychology, or there's this cost minimization, I don't know exactly how you want to phrase it, where at some point a monetary system will break down in the country and people will go to an alternative.
What's interesting is how long that process takes. When we talked about people taking wheelbarrows, I mean, those people in Germany with wheelbarrows could have started transacting in Swiss francs, which are perfectly stable at that time, but they chose to use their own government's currency. It's a fascinating thing because there was
I guess
they're switching from one piece of paper to another piece of paper. When you look at it, you do a chemical analysis. It's the same thing.
Yeah, that's right.
Well, what happened before, but for the moment, in the case of Germany, not after World War I, but after World War II, which was a slightly different case, and it shows a different facet of it. Because of Germany was then occupied by the Americans, the British, and the French, they were able to enforce price control much more effectively than a domestic government could have enforced it. And they had price control, widespread price control. As a result, you didn't have inflation. You just simply had money not being used. You had barter being traded. And it's funny, they used cigarettes as money. They used liquor as money, cognac. I've always said it's the most liquid money you've ever had. Have I ever told you my story of my experience with cigarettes in Germany at that time? Shortly after this, in 1950, I was assigned to I was in Paris as an advisor to the American Marshall Plan Agency. And my wife and I and our 2 children in a small 4x4 drove from Paris to Frankfurt, where I was going to attend a meeting over there. And we started to run out of gas along the way, and there was no gas station around. So I went off and drew up off the Eisenbahn Autobahn and went on to a small station and got my car filled with gas, and then I wanted to pay her. Now, a woman did, and as it happened, I had French francs, U.S. dollars, British pounds, but no German marks, because I was supposed to get marks from the U.S. agency in Frankfurt when I got there. And she wouldn't take any of those because she said it wasn't legal. And she said to me, "Haben Sie keine Ware? Haven't you any goods?" And I said, "What kind of goods?" And she said, "Coffee?" And I said, "No, I have no coffee. Cigarettes." So we finally made a deal. I gave her a carton of cigarettes, which I had bought in the PX in Paris for $1, and got the amount of gasoline, which when I got to Frankfurt, I would be able to get from the US PX for $1. So I gave $1 worth of cigarettes and got back $1 worth of gas. She, in turn, had the gas at the official value of the mark was worth $4. And she regarded the cigarettes as worth $4. So she got $4 worth of cigarettes for $4 gas. It was good for her, good for me. I always used to ask my students, where'd the $3 go? But that shows what you get into.
Well, but that was a deliberate suppression of the monetary system and the price system.
But it's part of the reason why in Germany, ever since World War II, also you've had enormous political pressure on the government to avoid inflation.
Right.
And yet, right today, as a result of the pressures from unification, inflation in Germany is running what, 5%? 4.5%?
Yeah.
Very high for them. They're very great pressure to reduce it. So when you say 4% is okay, 4% is not okay for Germany.
Although that's not the...
I would say it's not that 4% is okay. I think just combining what you were both saying was you want some prices going down and some prices going up. And in the case of the United States or Germany, where our underlying economic growth is, say, 2% real, probably the inflation should be around 2%. Most people would say they can't tell whether there's inflation or not. If you're in a world of Hong Kong, where you have real wages growing at 10% a year and GNP growing at 10% a year, and you have some prices still going down, but you have all these wages going up, a measured CPI of 4 to 6% will be quote-unquote okay. Won't look as bad as the 4 to 6% does here.
Well, the other thing is that there's a fair amount of natural noise in inflation. I mean, a good example is that in 1986, the U.S. inflation rate was 0, and it just dropped discontinuously. Well, that was it was related to the collapse of oil prices at that time. Similarly, in Germany, you're going to have a blip of inflation as they have with an event like reunification. And I think it's important that everyone understand that you can't get prices exactly stable. You're always going to have these downward and upward 3 or 4% surprises. And the important thing is to keep it to that and not to have these surprises that generate 10, 15% or higher
Well,
rates
the
of
important
inflation.
thing is to have some way of getting discipline on the monetary authorities, which is more effective than we've ever had before, because it seems to me that we have no reason to have any confidence now that 5, 10 years from now, inflation in the United States will not be up to $10, 10% a year, 20% a year.
You know,
The
earlier,
markets certainly agree with you on this
Of
question.
course,
no,
if
the
you look at the
markets
market, what
they
is the
sit there
market?
and they say, we got a problem out here. We don't know what these turkeys are going to do in Washington.
no, that's
And
you
it's
see that
very
very
clear.
strongly in long-term interest rates. We have
Being very much higher
ridiculously
than
high long-term interest rates now if the current commitment to monetary policy is correct.
That's right.
But Dan, you said something earlier which I would want to take my exception to, which made it sound like we all believed in monetarism. Because Milton and I have argued for 20 years on this point, and I thought I gradually swung him around. But that's not, controlling the money stock is not the way I would want to see us.
No,
try
but
to
that's
keep
a question of
prices under control.
definition. We all believe in monetarism in the sense that there's none of us who would say, all of us would agree, number one, that inflation is a monetary phenomenon. That number two, inflation under a fiat money system is made in Washington and nowhere else. Number three, that there are many different reasons why you might get inflation. Now, the question of whether the way in which to control, and we would all agree that rapid increases in money supply will produce inflation. We would all agree, I think, that without rapid increases in money supply, you would not get inflation.
Right.
I think that's a series of propositions that every one of us would agree with. Is there any you want to differ with?
Well, there's some I don't want to elaborate, but go on. I don't want to.
All right. Now,
I think the thing I'm really going to disagree with is still to come.
But no, the question is, how do you get a system under which the quantity of money moves in moderate ways without producing substantial inflations or substantial deflations?
Right.
How do you avoid episodes like 1929 to 33 when the quantity
Sure.
of money fell a third?
Absolutely.
And we had a major depression.
And the price level fell.
And the price level fell almost in half. How do we avoid situations like 1970s when you had very continuous rapid increases in the money supply and in inflation? Now, there are various ways of doing it. One way I've championed for a long time is to try to put a rule on how rapidly the quantity of money can change. Now, I'm not saying that's an ideal or a perfect rule. It isn't. But at least it would avoid these major differences. You have been in favor of different kinds of rules which would also avoid those differences.
Right. The key thing in both of your propositions is there's a rule.
That's
You've got to do
right.
something.
There's got a rule.
And
Yeah, I mean, but see, when you start talking about a rule and you start writing down what the rule would be, then I think that making a monetary rule encounters very severe problems because of change in the monetary system, which has generated more competition from credit cards, and all kinds of things have happened that are eroding the position of the paper dollar. So it's hard to set a rule for the paper dollar, whereas what we really want to set the rule for is the result, which is, in the longer run, simply the inflation rate.
Well, you could set it for the inflation rate. What's your, I never have gotten your reaction to the rule that, not the rule, but the method of accountability that Bob Hetzel has proposed, which is that the federal government issue two kinds of bonds, one of which is like the present bond that's paid so many dollars per year, 6%, 10%, whatever it may be, and the other of which is a purchasing power bond, which is adjusted for inflation.
Right.
So that I buy a bond for $1,000 at a, let's say, 4% interest rate. But let's say it's a 10-year bond. If at the end of the 10 years price level is doubled, I get back $2,000, not $1,000.
Right.
And year by year, instead of getting, let's say, $50, which would be the 5%, I get, if the price has gone up 10%, I get $5.50. If it's gone up 20%,
Right.
I get $6. And what Bob proposes is that the Treasury should issue two long-term securities, identical in every respect, including amounts, of these two kinds. Then the market will price them, and the difference between the interest rate the market puts on the one and on the other will be the market's expectation of inflation.
Right.
And that the Federal Reserve should require to keep, now I add, this is as far as he went. He just wanted that as information for the Federal Reserve, so the Federal Reserve would know what it's doing. But I would put on it the additional requirement that the Federal Reserve be required to keep that differential less than 3 percentage points.
Yeah, okay. This is very similar to ideas that I've been pushing for
Yeah.
quite a while. You can do it just in terms of the consensus forecast for inflation or for some other measure, some
But
other
this is
nominal
really a
measure.
This is
market.
market-driven.
This
Yeah,
is a
put it on
no,
the
that's
market.
right. Well, you know,
forecast.
you've probably heard my most extreme idea, which is that you could issue a type of index debt very similar to that, and then declare that type of debt to be the dollar.
No,
and
no,
then
I-
the purchasing power of the dollar is guaranteed at all times to be exactly what you want it to
Yeah,
be.
yeah.
And that's the ultimate version of this.
Well,
That's, I think, we're far from political acceptance of
We're
what
far
the
from political
total automatic
acceptance.
stabilized dollar.
There's the much more blunt edge instrument, which is what New Zealand does. If you don't, I think it's part of the constitution of the Central Bank of New Zealand, that the Reserve Bank of New Zealand, that if you don't keep inflation below a certain level, you're fired, Mr. President of the Central Bank. So it's written in the constitution of the Central Bank, of the Reserve Bank of New Zealand.
yeah, the real need is to make the people who are in charge accountable.
Yes.
New
But we
Zealand
have to
does
then
that
state
by
very
thing.
clearly what it is we expect them to do.
All right,
And
suppose
there's where
we,
need to-
that's what I was saying.
New
If they
Zealand's very
don't
clear.
keep the difference between these two interest rates that I talked about, less than 3%, for every 0.5% they go over, their pay gets docked 20% or something. You have to have a sanction. We have none now. There's absolutely no cost imposed except public opprobrium. And
Yeah,
public
but don't-
opprobrium is so widely distributed among so many guilty people, it doesn't amount to
Yeah, but it's not working that badly. I mean,
Tell me who paid a price, what individual, what Federal Reserve official paid a price for the inflation of the 70s?
William Miller?
Yeah, I thought that, I mean, Dan already mentioned that
No, I don't
the
think
President of the
Miller
United
did.
States
The president,
paid
but
the
I'm
price
talking
and was
about
not reelected. So.
in 1929 to 33, Herbert Hoover paid an enormous price.
Right.
But the people who ran the Federal Reserve did not.
No, but
And of
they're
course,
part of
Herbert Hoover was led to say in his memoirs that he discovered that the Federal Reserve was a weak reed to lean on in time of trouble. I like the New Zealand plan, whereby Dan Brash, who is a governor of the Bank of New Zealand, has a job under which, if he doesn't bring inflation below 3%, he gets fired.
What if it drops below 0? Does he get fired if it begins to go negative?
It's not
I mean, that was the
provided.
problem.
When
That's
I
not a
la-
provision of.
But when I
so
last
the,
saw him,
the 1929 disaster could happen in New
I
Zealand.
saw him recently, and what he
Mhm.
was worrying about was that inflation had been coming down faster than it was required to come down, and he was afraid that it was going to get down too low.
Yeah. Okay. All right, so I
Your
see.
problem.
Yeah.
But it seems to me that I would say any of these things would be good, provided it makes the people who are responsible, namely the people who run the Federal Reserve Board, those 19 people around the table, you have to make them accountable. And right now they're not accountable at all.
Well, how do you explain why they're doing such a good job if they're not accountable at all? It seems to me that there's some degree of accountability. You and I would
I
agree
wouldn't
that there
say
should be
they're
more.
doing such a good job. I think you're exaggerating the goodness of the job for a brief period now.
Yeah. Okay.
I would say at most, you could say it's been reasonably good for about 3 or 4 years.
Okay.
I don't think Mr. Volcker did such a good job. He
I don't
kept
think
going
Miller
up
did
and
either.
down.
Miller
Huh?
did a horrible job.
Well, Miller was
Yeah,
earlier.
Yeah, but the problem is that one individual has done a good job for a while.
That's right.
What do we know about the future? The answer is
I
not
totally
much.
agree.
I mean,
No,
we're at the
the-
discretion of one individual doing a good
No,
thing.
that's right.
And
And,
it's-
and certainly the history of the institution of the Federal Reserve shows very clearly that how vulnerable it is to this
I
problem.
think there's only one conclusion that can be drawn from this. The problem of inflation will remain with us for a long time. Misunderstanding about money will not go away. People will be sitting around 50 years from now the way we are, arguing about what they ought to do with their monetary system. And that, I wish we were going to be able to be here at that time, but we won't. So that's a nice end to our little discussion.